And no, I think that we can do a little bit the same. Let's let it flow a little bit, no, and let's see how it goes, and let's discuss different topics about venture debt, when it's more suitable, and a part of that as well, a little bit of the where is the ecosystem, or what's the situation in 2024, no? That maybe it's even worse now than when we discussed during the panel, no, in 4 years.
Worse.
Yeah, no, don't you think, Sergio, that it's decreasing? No, it's increasing. Do you think that it's increasing or decreasing, the investment?
Increasing a lot.
Increasing, eh?
Yeah, I'd say the opportunities certainly. I mean, in fairness, the overall numbers broadly across where all three of us operate probably are still down, at least not up on where they have been. But I would imagine the three of us probably would disagree with that from our own fund or bank's perspective. So, which is quite interesting, that we seem to be seeing a lot of stuff, particularly, I mean, 23 was extremely busy, if you want to take a whole calendar year. So yeah.
And talking about our product, venture debt, Jordi.
But it's increasing in venture debt. Okay.
No. My opinion is everything, at least in Spain. Okay.
At least in Spain, eh? But not the global figures, Sergio. The global figures are not good in terms of private investment. I saw last day basically a chart that it was really, maybe it's accounting as well the states.
Yeah, maybe it's if you compare it to the all-time high, it's low.
Yeah,
but I think it's recovering compared to 2022.
Yeah, I think probably what you get.
A very good webinar, a very positive message then.
Yeah, I think you'll get a mix of people, are probably your funds are a little bit more, maybe have a higher bar, so it's sometimes harder to find as many deals you want to do. But if you're able to be seeing those companies you want to back, actually there's no disadvantage at all. So I think the experience of a lot of funds is actually it's busier than it was, despite the overall numbers maybe globally being down.
Maybe they're competing all on the same deals. That's why,
exactly,
that's why experience is that it's busy, but the overall market.
For example, at least my experience this 4 months in Spain is that there are a lot of opportunities, and there are a lot of new investment rounds. Okay, come. Say hello.
Hey, I thought the CEO was there.
No, put here. No, it's a seminar.
Okay.
Hey, Cormac.
Hey, guys.
Hello.
For example, my feeling is that there are a lot of new capital increase, new investment rounds, but with a very high secondary discounts. I mean, to have the blended, at least in our portfolio, and what we have seen during these 4 months, is that venture capital, they have a lot of power, a lot of money, and they want a blended good opportunity, and maybe they are offering good or reasonable multiples for the primary, but discounts of 40-50% in the secondary, in good companies, very good companies.
But the investors have to sell, right?
Yes.
Yeah.
Yes. At least in Spain, I don't know. But it's good because it's people who maybe they invested 6-7 years ago, they don't want to wait, so they can accept it. High discounts, and for the company, they keep the primary, but the blended is fantastic.
Yeah, we've also seen rounds with a lot of warrants and things like that, like structured rounds where the label valuation is higher or the same, and then the actual valuation is lower.
I'm speaking in A plus B, so rounds from 10 million.
Yeah. But it's a very different behavior than the US, right? The US, they're like, okay, it's down 80%. Let's discount it. In Europe, they're masking it, but the true number, I think the valuations are all down.
Yes.
Interesting. So, okay, so if you want, let's start, no? Because we allowed 5 minutes of courtesy, but actually normally the beginning is quite interesting, no? Because this discussion is quite interesting already, no? So let's start basically introducing you a little bit to the audience. So Fatou, you are founding partner, no, of Bootstrap Europe, a venture debt fund managing 900 millions of euros.
No, 250, 250. 900 is the total.
No, 100 is the total.
Yeah.
Now it's at 250 alive fund, no?
Yeah.
And you have already deployed 340 loans, no, from 2015, right? And basically, I'm financing all Europe at the moment, no? It's basically you are working in many companies in different countries. So it's going to be very interesting your European view, as well as Antony Baker, no, principal at Claret Capital Partners, managing 600 millions under portfolio, more than 200 companies, and you have already deployed some venture debt funding in Spain already, no? in different companies. So you know the Spanish ecosystem as well as the UK one and the other European countries, no? And as usual, venture debt suspect in Spain, Sergio Pérez, no, representing
Venture capital.
and venture capital, no,
And
so,
equity.
and many. Well, one of the first. No, you have started already many years ago in the ecosystem in Spain in venture capital, then as well in venture debt. So you have a very good knowledge of the progress of the ecosystem, that it has been quite good in Spain and now in venture debt, no? There are different venture debt funds a part of Sabadell Ventures. There are other options, but it's increasing the players in this particular way to fund startups, no? So for me, the first question, and basically to establish a little bit the conversation, no, is let's describe a little bit the product, venture debt, and when do you think that it makes sense for a startup to apply to this kind of funding, and what kind of projects do you think that are more eligible, no? Maybe we can break the ice in that sense, no? I don't know, Fatou, do you want to start? Basically, ladies first, to comment a little bit in regards to the basis of the product, profile of the startups that make sense to apply or finance, no, in your eyes.
Yeah, thanks, Jordi, for having us. So we are a venture lender and we invest all across Europe. To be very specific, it's a loan that's very similar to, let's say, your real estate loan, in the sense that a company will take the loan and over 3 to 4 years repay it every month, interest and principal, with a little bit of maybe a grace period at the beginning where you only pay interest. And the real question is, why do companies do that? It's usually a way to reduce dilution. When you have a very fast growing company, it makes sense to wait until you reach certain milestones before you do a valuation event, raise capital. And venture debt is exactly this. It's like you have a rocket ship, you take the fuel, put it in your rocket, reach another level. And let's say if you double your revenues, you might raise at double the valuation. So it makes sense to wait and delay the round. Or maybe you want to accelerate it and grow faster, reach that milestone faster. So we invest, it's a form of lending that exists in different sources. And I think we all have our different ways and different appetites and how we do that. At Bootstrap, we like to invest in B2B companies, Series A or later. We've done a few seed, but it's exceptional. We like to do nerdy type of investments. So for us, a company, in deep tech, climate tech, fintech, life science, that has reached a point where they have a product market fit. They know the unit economics so well that they understand €1 of venture debt is going to result in €3 of revenues, and that's going to be valued 10 times. So that's €30 of value. You want that relationship to work. And we want those fast-growing companies because we also get a warrant that give us a little bit of upside in the equity if the company is successful. In a nutshell.
Okay, fantastic. So basically, companies that they need to leverage a little bit with debt, if they go to a bank or a traditional bank, it's going to be very, very difficult to get some kind of debt from banks for the States. No, it's a fast-growing company, and to obtain a quite good quantity of debt, it's suitable to go to venture debt option. No. So, Antony, what's your view? What do you think?
Jordi, only to add, I think that it's important to understand that venture debt is very similar than venture capital.
Okay.
In the sense that there are different stages, but it's one step forward. That means, for example, in venture capital, a seed company is when you are looking for market fit, you have the product, and you have the first sales. Okay, so in that moment, it's impossible. Impossible is nothing, but it's very difficult to get venture debt. Okay? But if you go to the next step, that I don't know what is the correct name, but Serie A, pre-Serie A, I mean, that you have some revenues, maybe 50, 60K of MRR in a SaaS company. Usually, in that point, you can get seed venture debt. That usually they are the local players. Okay,
right.
In France, the local, in Spain, in
so
UK.
Let's say that you can get 500K from a Spanish venture debt.
500, 1 million, something like that. Okay, but the big difference is the conditions. I mean, usually in that stage, you're looking for a company that you have, or you think that you have a high percentage to get the Serie A, okay, because if not, it's almost impossible to recover the money, okay, but the price is slightly higher than the venture debt Serie A or the next step. It's like in venture capital, okay? In the next step, you can look for the venture debt with pan-European people that maybe it's from 2-3 million and go ahead, okay? So it's important to split in that two moments.
Yeah, and I
Okay,
think maybe just to jump in, and sorry, Jordi, I know you were going to probably ask a different question, and I agree a lot with what Fatou and Sergio said there. And maybe kind of wrapping it up and coming back to your question on the stage that it makes sense to access, and as we've been saying there, it's maybe different throughout the lifetime of a journey, throughout the lifetime of a company. But I suppose the other way to answer it is really the timing, like when is that right? And that's where we spend a lot of hours in the day trying to work out where and when we are relevant and selecting the right timing. So there is typically a time in every growth tech or life science business where it should have access to those alternative types of financing aside from equity, and that should be to help it to help support its growth before turning profitable or exiting. And most companies, if you think about exactly as Sergio was saying there, will have multiple events along the way where they need to raise capital. And at certain points, they should be able to unlock alternative, less dilutive financing options to equity. And either that reduces their dependence on equity or it substitutes an equity round entirely. So then I guess being more specific at what that then means, maybe for us as we look at venture and more growth stage at a high level. And again, there are exceptions. Businesses that are the right fit are those that are revenue generating. They have a track record of sustained revenue growth. They will have good business models with strong margins that demonstrate product market fit. You should be able to see pricing power. And ideally, you're looking for some level or a decent level of forecastability. The majority of those companies, but not all of them, will be VC or equity backed. And then I suppose you come on to the second part of your opening question there, which is what are the projects that actually kind of it works for and that are eligible. or eligible for it. There are multiple use cases that I guess all three of us will see where venture debt actually suits the situation of the business quite well. So quite often you're seeing it to support organic growth, so funding the organic burn of a business so that it grows its revenues as quickly as possible and therefore scales the enterprise valuation of the company. Or another huge part of our business is to fund and support M&A. So you will quite often see some of the leading or emerging tech players in the market look to consolidate others and finance the acquisition of such targets without raising equity. So that constitutes about half of the euros that we would fund.
And finance some assets, no? Imagine that you are renting bicycles, no? If you need to buy a lot of bicycles, then it's another option, no? Maybe to get some debt to, or maybe if you have a fintech and you are basically giving credit to SME companies, you need to get to access as well to debt funds, no? Maybe that as well is another profile. So basically, to understand the profile, one is going to let's say in the way to obtain a profitable company or a break even, no? Back up by capitalization and venture capital, ideally, and then possibly an M&A. I write down this one, Antony, interesting, no? M&A structures can be another option, and finance assets, no? As well as an option to finance these assets instead to dilute your company by private rounds, no? Do this investment to assets using venture debt, no? That's an option, no? And possibly if you go to a bank, it's impossible, no? To go to a bank at this stage is good luck, no? So yeah, Fatou, carry on.
No, I want to say it's true that venture debt started as venture leasing, right? In the 80s, where companies would use it to finance hardware. It changed because companies went asset light, there was really the wave of software companies. But I think today we see a lot more hardware deals where a company might want to finance, manufacturing, or we do, for example, a lot of semiconductor investments where there, the machine is 1 million, and this is not a good use of your equity capital. So debt there is a perfect companion. The caveat, and we're going to get to who should not get venture debt, but typically we don't like to finance loan books because it is not, venture debt is cheaper than equity, but it's not cheap.
Right.
And if you have to finance a loan book, you need a serious margin on top of that. So I think if you can get that from specialized finance or from certain banks who like to finance those assets, the late Silicon Valley Bank used to do that in a way, that's a better alternative.
Yeah, it makes perfectly sense. And in terms to understand your business model and the product itself, basically you have an interest rate from, let's say, 9 to 15%, no? Let's clarify that a little bit right now. You have amortization period, maybe 3 years, no? As benchmark, and you got an equity quicker, no? You got a percentage as well of the company, no? So normally it's a 15, 20, 25% of equity quicker and kicker. You've got as well some kind of warrants, covenants. So, well, the contract is not short, it's quite a heavy contract, no? So let's comment a little bit about the different parts of the contract conditions, and in order to understand a little bit your model here. Sergio, you are jumping, no?
Yes, I mean, I think that it's not heavy. It's a contract for a loan. I mean, think that we are covering a lot of risk. So usually we split between the loan and the covenants or the guarantees, okay, that we get. And being very transparent, the second one, it's paper. Because in a startup that you have software, you don't have a collateral. The reality is that you don't have a real collateral. But the next question is, so what are you doing that? it's very simple, is to avoid that they jump us. If something happens, we are not going to recover nothing, zero. But, for example, if things are in the middle or someone wants to acquire the company, they have to take into account that the first to receive the money is debt, and after that, equity. So
Right.
the reason to have that, it's very simple, is to avoid to jump us. It's not because it's a real guarantee or a collateral. We are not speaking about a factory or something material. It's to protect us, that's all. And I think that it's, of course, it's a contract, but it's very simple. I mean, you have to take into account what is the price, what is the equity kicker, okay? Usually, what are the collateral, the guarantees, and all the other things, it's very typical. We need information, we need that if you sell some assets, first pay us. So it's true, you need to read the document. But it's not, I think that because maybe you are more used to read capital contracts or investment agreements, things like that. But in fact, I think that the venture debt paperwork is very easy.
It's very easy. Okay. So basically, your intention when you are funding a company is recover the money, with an interest rate. That's the main objective. And then the equity kicker, it's just to have some kind of upside to protect some companies that you fund in terms of debt and they are closing.
Default.
Is that like that?
Yes, it's a venture debt fund. It's very easy. I mean, imagine that it's ideal. So you are going to get the interest rate, that's all. But unfortunately, we lost because we have defaults. Sometimes it's a risk business, or sometimes we fall. So we need to recover that with the equity kicker from the companies that they are working better than we expected. Otherwise, we cannot cover the defaults that we get in our portfolio.
Right. So you need this kind of upside in when using the equity kicker, basically. Okay. What's your view, Antony, or what do you think? And one question here, no? In terms of conditions, do you agree that it's more or less interest rates from 10 to 15, equity kicker from 15 to 25? But in terms of conditions, are there many differences from the Spanish venture debt players and the international ones like yourself, apart of the ticket and the capacity? Do you observe different conditions? For example, no? I know that Factorial, a SaaS company in Spain, they obtained a venture debt after around Series B, that they didn't have any equity kicker at all, for example, no? So is there any difference are there many difference in terms of conditions from the UK funds and as well other countries rather than comparing to Spain?
Yeah, great question. I think there's a fair bit of variance just between providers generally, as well as geographically. I mean, I'll start maybe talking about how I think about Claret. We provide investment in the form of flexible secured term loans, which have a fixed timeline for repayment over, say, 3-4 years, and modest equity kickers. I think it's worth kind of flagging and really interesting what Sergio was saying there, but we think of the equity kickers very much as upside, not necessarily an insurance, alongside the credit story, but actually a key part of our strategy, in that we are providing significantly less dilutive capital to help these businesses scale, and we then kind of win on the equity kicker side when those businesses win as well. So it is an actual key part of our strategy rather than an insurance against any, hopefully not, but any weaker credits in the portfolio. to answer the question more specifically, you'll see a range of deal structure and pricing, both between funds themselves. So, for example, between us and Bootstrap, but also between funds and banks. So us and Sabadell. And I'd defer more to Sergio on the banking structures, but on the funds, you might expect to see low double-digit rates. So maybe not quite as high as the 15 that you mentioned there. So more on the lower end. But there are exceptions either way. It will vary, case by case, based on the maturity of the business, the geography, the sector, and so on. But we will always, in every single deal that we do, as I mentioned, have an equity kicker, and normally that is in the form of warrants, although there are other things you can do. As I say, it's considerably less dilutive than pure equity. And you mentioned covenants as well. In the original question, covenant-wise, it's fairly rare for funds to have these, although there are exceptional cases. That tends to be something you maybe see more on the banking side. In terms of international versus Spain, you touched on it a little bit. The international funds generally larger in size, so typically can fund larger tickets. You obviously have the international relationship side, so they tend to be a lot more broad, whether that's with VCs or growth equity, other entrepreneurs, and all of these relationships can be leveraged, and you have a broader portfolio that's more distributed to help make connections and leverage to the benefit of a certain company. But the reverse is also true, right? The Spanish players and those based in Spain are obviously going to be much more embedded, and quite rightly so. So they will tend to have very deep relationships with people actually on the ground. Pricing wise, you really do get a range. You probably would expect there to be a lot of difference pricing wise on the interest rates and warrant coverage. I think they're gradually reducing as the markets become more competitive. But there are probably a fair few differences on the interest and the warrant coverage.
Okay.
I think just to complement that, I think the difference really, as Sergio was saying, you go in, you do seed venture debt, you can go at a riskier stage, maybe than international lenders. And so that maybe justifies higher warrant coverage rate. It's more of an equity risk. And so you're taking more equity returns. It makes sense. What is very different in Spain, in my view, is a good example is our first investment. We did it as a co-investment with a Spanish lender. And I thought this was the best of both worlds because they brought the local knowledge, the relationship with the founder, and that was really important to the founder. We brought additional lending capacity and international, let's say, structuring, because we can be, I think what we do a lot is very creative structures. You venture that is one model, and then you can kind of invent around it. And that really suited the company. And the more you see, the more jurisdictions you see, the more trouble also you see, you can be more creative. So I think when we did the co-investments with Spanish lenders, there was not a huge difference in the lending philosophy. It's just maybe how you translate some local specificities.
Fantastic. Yeah, it makes a lot of sense. No, maybe more seed venture debt in Spain from Spanish players, then more risk, more return, no, and more maturity stage. But the view, as you mentioned, is quite similar, no. So in terms of venture debt ecosystem in Spain and basically the opportunities that you can observe as internationals here in the Spanish ecosystem. So well, Spanish has developed it's an early market, no? So if we come back early days, 2000, 2005, we have the first venture capital firms established. So after 20 years, we have now more players in terms of venture capital investors, seed stage, Series A, Series A plus. We don't have big large funds like in Europe, but let's say that the venture capital ecosystem has developed a lot. Venture debt now it's the beginning, no? Let's say that we have 4, 5, 6 players starting, but there is still an opportunity, no? The gap between venture capital and venture debt maybe it's bigger in proportion than other countries like UK, no, or France, or other or even Germany, no. So first question for me, maybe for you, Sergio, no, do you think that there are opportunities for more players to entry to the Spanish ecosystem, create more venture debt funds, and you, Fatou and Antony, as internationals, maybe you see Spain as an opportunity as well to cover this gap for this late venture debt stage?
Okay,
Sergio,
so of course, I don't have the international view that maybe Antony or Fatou, but in my opinion, Spain in the seed venture debt, we are very mature. If you compare, for example, with Germany,
right?
Germany, there are no or a few venture debt providers in the seed, and in UK, exactly the same. And we are speaking about the UK. In France, there are a lot of public funds, but not venture debt. And in Portugal, zero. So, in my opinion, always there are opportunities, of course, but for seed venture debt, I think that Spain, it's one of the, I don't know if more mature, but we have a lot of players. Okay.
Interesting. That I didn't have that impression. It's very interesting, your view. So you think that Spain is pioneer in having seed venture debt funds, no?
Yes. I don't
think
know,
I
Antony, but
agree
you
with
have more.
Yeah, I think it kind of boomed in the past 3 years, I would say. So, you know, from 2015, 14,
Right.
15, 16, we've been looking at Spain for venture debt, and it was still slowly, and suddenly it just exploded with everyone entering the market, banks coming in. I don't know, when was the lending activity started at Sabadell to startups?
2016.
Yeah, so it's really, and then you have BBVA and Santander all coming in the market. You've got the international venture lenders coming in already. So I think if you want to raise venture debt, and usually it's entrepreneurs, to the people on the webinar today, it's people who can raise equity but choose not to raise everything in equity. Not that they cannot raise equity. If you don't have equity on the table, do not take venture debt either. It's more a poison. But the ones who can, you can really compose your debt syndicate as you want. You can partner with the lender of choice that matches your maturity stage and then continue refinancing. I think the entrepreneurs in Spain have much, much more choice than I agree in Germany, for example.
So maybe, Sergio, for the local players, maybe the opportunity is to create bigger funds for the late stage then.
Yes, but I think that we have it. I mean, right now we are, of course, we are not as big as others, but we can put on the table tickets of 10 million, something like that. So, in fact, we collaborate and we compete with all the players.
All right. Interesting.
So we are three here, and I think that we compete and we collaborate in different deals. So I think that, for example, in our case, we only provide for different reasons, we only provide venture debt in Spain and in Portugal. But if I have the opportunity, I would like to go, for example, to Germany, Greece, things like that. I cannot do it because I work in this institution. It's fantastic, but we are focused only in Spain and Portugal. But I think
you can see the gap there to go.
Yes. Yes.
Okay.
Yeah, I think it's
Latin America.
Yeah.
Not, I don't know. Latin America, I don't know.
I think
Yeah, carry on, Antony.
I think Sergio's kind of opening point there is spot on. We operate across all of those territories, and it is definitely more active on the venture debt side at that seed stage in Spain than those other territories, for sure. And each jurisdiction has their own kind of little nuances. And Sergio mentioned France, where there's lots and lots of bank debt that has been very cheap in the last few years. But you don't see as many of the funds operating there. For example, the UK used to have a lot of SVB at the earlier stage, and they were absolutely brilliant at it, in fairness. But yeah, I would say we observed the earlier stage seed venture debt is much more competitive in Spain than probably anywhere else.
Wow. Oh, so maybe in your case, why don't you create a seed venture debt fund in your countries, no? Because maybe if there is this opportunity, it makes sense to basically create a vehicle, no, there in that sense.
But for example, Jordi, I repeat, I'm not an expert, but for example, in Portugal, that we
Yes.
started in 2016
Yes.
to try to do a deal, we only made one deal in Portugal, only one. Why? Because there were so many public funds that they offer loans very, very cheap that it was impossible for us.
But
Impossible.
we have that as well in Spain. We have a lot of public.
No. Really, it's not the same.
Even more, eh?
It's not the same in Portugal.
Okay,
And
we
in
need to open a
France,
branch. We need to open a branch in Portugal then. No?
but for example, in Portugal, they had, but not now, a very cheap loans from the government, and also it was a tax incentive that
That's
a lot
nice.
of venture capital appear, and the price of the rounds go very high. In my point of view, without sense, but it was impossible because they prefer to get capital.
Yeah, subsidies.
So it was the market. In France, there were a lot of public funds, a lot, really. It's funds and a lot. But for example, in Germany, no, and in Italy, it's a legal issue, okay? We tried to make 2 deals there, and finally we rejected because in Italy, if you have a problem, always the company has the reason, always. So you cannot have any guarantee, zero.
We don't
Right.
invest.
I'm not an expert,
For
but
example.
You don't invest in Italy neither, eh, for that reason. See, that's extremely interesting. But in UK, there are not many public funds for the entrepreneurs. So maybe it is an opportunity, no, for seed venture there.
I have a strong view
yeah.
on seed. Antony, go ahead.
I think we're going to say the same thing, I guess. There probably is an opportunity. I think we are definitely later stage investors than that. And all of that comes back to the point I made in the opening question about timing. And when, you know, from our point of view and our experience, and what we spend a lot of focus on is it the right timing? And so those earlier stage seed companies probably haven't yet demonstrated the product market fit, and the various other things that we might look for yet. And so probably don't necessarily fit exactly with our mandate and strategy. That is not to say they're not amazing businesses that will do. But our focus and our experience is at that slightly later stage. So we tend to look at businesses maybe 4 or 5 million in revenues as a minimum. And in the UK, there are a lot of them. So that keeps us busy enough as it is, and it's, you know, extremely competitive at that stage.
Right. And basically, as you invest before in other companies in Spain, what's your vision of the Spanish ecosystem of startups? What do you think about it? Are you willing to deploy more funding? What's your strategy for Spain? And as we have some Spanish entrepreneurs in the audience.
Let me tell you this fact that I learned in the past few days, is that the EU has decided through the European Investment Bank to invest 1 billion in growth equity in Spain in the coming years. So at the peak of the market, Spain was 5 billion, right, of technology investments. This is 2021, right? And it's come down 20% every year since then. So them putting that amount of equity in the market, even if only 20% of these companies succeed, it creates an immense investment opportunity for the VCs, the growth funds, and the lenders. We are a subset of the venture market. So the more dynamic the venture market, really the better for us. Now it's retreated. So yes, it creates opportunity for us, and that is attractive, but really we like it when it's booming, because we are getting paid on the warrants as well. I have to say, venture debt for us is just a way to get into the best companies. And we want these warrants to be 2-3 times the returns of the debt, not just compensating the losses. So for us, it's like massive opportunities. We're voting with our feet. You see us on this podcast. We are coming to do a bit more education in the market, partnering with the local players, because we do believe that you guys have the best knowledge of who are the repeat and best entrepreneurs. Yeah, so everyone on the podcast, just hit us up. We really, really want to do more business in Spain.
So
I think,
we are more
Fatou, that's
welcome.
it's a great point that the equity kind of provides some of the fuel upon which we then have opportunity. So it is fantastic to see that happening in Spain. And I think going back to your original question was, how do we see the ecosystem in Spain? And we're huge advocates of this, the startup scene in Spain. I think if you could see the weather in London right now, then you'd understand why we all like spending so much time there. But on a serious note, and I think this is probably great for all the people, all the founders that have joined. You have lots of very strong, very smart founders and entrepreneurs building innovative technology businesses. And there's a host of well-known logos, some which we're fortunate to have backed, like Job and Talent, Playtomic, Exotica, and so on, which are testament to that. And the market is very mature, and that comes from all different areas. And Sergio was saying that the earlier venture debt funds are part of it. But there's also, this universe of very strong and well-established VCs, CIA, JME, Sabadell, Kibo, Adar, and so on. And the legal frameworks are the same. And it came up earlier about, the contracts for venture debt quite complex. Well, actually, again, probably I would agree with Sergio, not really. They are fairly standardized and I suppose a little bit different in terms of equity, and shareholder agreements are a two-way contract, whereas the loan documents really are created by one party. So they're a lot more simplistic, but going back to my point, it's very well documented, well developed, and venture debt has really become part of the mainstream, and the product is, I guess, part of the toolbox available to companies to scale their business. And the final thing I would just say on Spain generally and the startup ecosystem is something that I always say whenever I'm asked this question, is that it's easily one of the best territories for collaboration. So companies in the ecosystem seem to really support and look out for each other. There seems to be a lot of working groups and organizations for partnering and sharing that we hear about. And it's probably fair to say that we tend to get a lot of intros, or certainly more intros to opportunities from CFOs of other companies, trying to help their peers, compared to any other territory. I'd say Spain is easily the best for collaboration.
I'm gonna do that, Antony, after the webinar. Have a couple of opportunities for you, spectacular. So
there we go, perfect.
So that's great. So yeah, we were discussing at the beginning 2024 forecast situation where we are, and I was very surprised. You were very optimistic, no? That it's a year of opportunity. It's a year that you are finding great options to invest, to fund different projects. So let's have a look to this 2024 a little bit overview, where we are. What do you think that if we are going to improve, it's going to be better than 2023? We are basically in a better situation than last year, or not? Sergio, you were especially optimistic, no, this year.
I was entrepreneur, so
okay. You have this contagious effect, no?
So yes, I'm very optimistic because last year it was very hard, and this year I started with a lot of opportunities in capital and in venture debt, because I think that all the venture capital firms want to deploy money. We were waiting to see what happened. And after last year, we think that, okay, we have to deploy, because we have LPs that they're asking for return. So we cannot wait in eternum. So we think that now, at least, our feeling is that we are better than last year, and I think that it's going to improve. So I think that the second term is going to be better than the first one.
Okay.
And I think don't forget that, like, interest rates are starting to soften a little bit. It's almost like survival of the fittest. 2022 and 23 were really hard. So the ones who have come out of it on the other side look in much better shape than ever. The ones who are seeking venture debt today compared to 2023, they are more profitable, they are growing at the same rate or more because they took advantage of the dislocation. There is a lot of technology and it's even faster to accelerate on your technology. I think almost all the software companies we're invested in are using AI to speed the adoption, the sales, and change their product. And that reflects in the sales. That reflects in their ability to raise funding as well. So I mean, we're cautiously optimistic. There will be a few spectacular problems, but I think VCs are finding optimism again. There are some cautiously, signs of exit opening again. We sold a company earlier in January. There's another one now in discussions for exit. So I think it's all looking green.
Interesting. Antony, what's your view in 2024?
Yeah, for this year, I think it's hard to not kind of repeat the message and talk about the last couple of years and the reduction in availability of capital more generally, and the big, what I'd call retrenching in perceived valuation of tech businesses, resulted in obviously a lot weaker of a VC market, but presented a lot of opportunity for venture debt, which we expect to continue. I think it's worth repeating Fatou's point about, we want that equity to rebound and continue to fuel those businesses and ensure that there is nice, efficient growth businesses that we can back. And I agree completely, again, with Fatou's point there. The last 12 months have seen a huge focus on efficiency and profitability because companies have had to adapt to that scarcity of capital in the market. And the knock-on effect is exactly as you said, that there's so many companies are adjusting their models in a way that lands them right in the sweet spot of what a venture lender likes to back. So there has been a huge amount of opportunity that has come from effectively the drop in VC investment, and ironically the increase in interest rates, which obviously reduced all the valuations of the tech businesses.
But don't you think, Sergio, that in Spain now there are different funds, venture capital funds, fundraising? Don't you think that they are going to be on trouble on that, on this fundraising? Well, in your cases, you have an LP, no? But I can see now some kind of fragility, no, on these fundraisings at the moment. Maybe they have some spare tickets already in the existing funds, but don't you think that the next funds are going to be tougher? And the first time venture capitalists are going to be practically out of the market? Don't you think that?
Maybe I agree in that. I think that because LPs, they have other opportunities. Also, usually if you invested in a venture capital firm, the DPI the last 2 years, it was very difficult. So if you're an LP, you want to see return before to invest again. So maybe they have to wait one year, 18 months before to go again. But saying that, I think that it's going to be good because always after a crisis, you have a good vintage. So if you think as an LP, okay, it's very difficult, okay? But if you think as an LP, not as an investor, I think that the right moment to put money is now.
Yes.
Because valuations are lower, or the multiples are more rational, not as crazy as before, okay? Companies, as Antony said, they are looking for profitability, okay? They are thinking in growing, but before, it doesn't matter, the EBITDA. They are only looking for sales. And now, they are thinking in both. So if I will be an LP, I think it's a good moment to invest in venture capital, but the reality is that, as you said, maybe it's going to be difficult.
Yeah, you are right. Maybe if we come back to 2008, 2009, 2010, we had a very good entrepreneur batch there in Spain. And if we think about maybe Cantox, the Port Village, we have companies that they were starting there, no?
And maybe it's funny because we are in a venture debt panel, but as an LP, I think, and I have only
That
an
you
LP.
prefer venture debt. You prefer venture debt right now? Maybe.
No. I'm not
Okay.
prefer one or the other because I have two sons, so
Yeah.
I have equity and venture debt, so I cannot choose between one and the other. But as an LP, you have the DPI. I mean, in the venture capital, when you invest, and maybe until the 6th or the 7th year, it's very difficult to have a return. But in the venture debt, okay, you are not going to have 3x, something like that. But you have the DPI every 6 months or every year. So I have two sons. I cannot choose between venture capital and venture debt. But as an LP, I think that to have a mix between venture capital and venture debt, it's a good option. Because you have the risk and the high return in venture capital, but you have the return of the venture debt that is going to be.
You have more liquidity, no? You have more
Yes.
liquidity as LP, no? So that's a good point, no? Maybe for you guys, Fatou and Antony, now to proceed to a fundraising, maybe this environment for you is a good advantage, not to convince LPs.
Yeah, I think it should be a good one. And going back to Sergio's point there, and appreciate being very diplomatic with the two children. But my take is, theoretically, it should be very difficult for first-time managers in VC or those with not so strong a track record of DPI. And going back to Fatou's point, there's maybe not been so many exits, and there's a few coming in now, but there hasn't been a huge amount. And then we, of course, have the flip side that theoretically venture or growth debt should have much more stable, okay, maybe not quite as high a target return, but much more stable. And that should return capital much more quickly and earlier on in the life cycle of the fund. So LPs looking to deploy capital very quickly, which they will do with a debt fund doing a significant number of deals, and to start not only having that money put to work, but generating a return for them, will make a lot of sense. And I think what is maybe also interesting is historically, and Sergio would have a great view on this, the LP bases are typically pretty different, right? You're targeting different returns. So those investing in VCs or growth equity wouldn't be the same that you expect to look at lenders. But I do wonder if that maybe slightly changes. And one really interesting exercise, if anyone has the time, would be to just compare what the actual returns are per fund and the average, because that's really
what
where
we don't discuss.
this is really
That's
what
gonna be great.
interesting.
If one day we have this transparency, that will be spectacular.
Exactly, because it should be very equity will be much more volatile, but we'll have certain funds that have done extremely well, whereas the debt side should be much more stable. So it'd be interesting to see how they actually compare over a longer period of time. But yes, theoretically, it should be a good time for debt funds to raise.
Yeah, happy to share more data on that because we looked around and there is a bit of research available. So venture capital, as you expect, it's following the power law. There is 5% of the fund making 80% of the return. In Europe in particular, it's a bit harder if you look at the EIF public data, by the way, on all the funds they've invested in. The ones who return the money, they're not a lot, right? For euphemism. But so the dispersion is very big. Whereas in venture debt, as in all private lending, the returns are fairly consistent, fairly resilient. There is not a lot of outlier. So you choose your risk appetite, and smart investors, they do a portfolio construction that includes both, because as you say, your two sons, they're doing well in their different races. One is running the marathon, the other one is running a 100-meter sprint, and each in his category is going to succeed or not.
Fantastic. Interesting. Well, I could be speaking with you guys many hours. It's fantastic, this debate. But I think that let's close it here. But many thanks for all this discussion. It has been very constructive. Some surprise. I learned a lot. That we are in Spain pioneers in seed venture debt. That it has been a surprise for me. Wow, that's going to be a highlight of this webinar, apart of all the other insights that you comment. So many thanks for your time, basically your knowledge, and yeah, I'm happy to share with you opportunities here in Spain and create a good community. So many thanks for your time.
Yeah, thank you, Jordi and Fatou.
Thank you,
Sergio.
Jordi.
Pleasure.
Fatou, Antony.
Always
you.
a pleasure to talk
See
to
you.
you. Thank you.
Bye.
Take care, everyone.
Have a
Bye
good
now.
evening.